Why is U.S. Social Security taxed? The harsh reality for U.S. senior citizens. The taxation of U.S. Social Security catches millions of Americans off guard every single year when they enter retirement. You work for decades, you pay into the system with every paycheck, and you finally reach the age where you start receiving your monthly Social Security benefits. Then tax season rolls around, and you discover that a portion of those very benefits might actually be taxable by the federal government. It feels like paying a tax on a tax, and naturally, people want to know why this system was set up this way and how it actually works. To understand why this happens, we have to travel back in time to when the program was created in the 1930s. Originally, Social Security benefits were completely exempt from federal income tax. The logic was simple. Workers contributed money from their paychecks using after-tax dollars, and the government viewed the monthly payouts as a non-taxable welfare benefit meant to keep older citizens out of poverty. For nearly 50 years, retirees received every single dollar of their benefit checks completely tax-free, regardless of how much other income they earned. Everything changed in the early 1980s when the Social Security system faced a severe financial crisis. Reserves were draining rapidly, and without legislative intervention, the program was on the brink of being unable to pay out full benefits to retirees. In 1983, Congress passed major reforms to rescue the system, and one of the central mechanisms was introducing an income tax on benefits for higher-income retirees. The government decided that wealthier individuals who had other sources of income, such as pensions or investments, should pay tax on a portion of their monthly benefits to help generate revenue that would flow directly back into the trust funds. The mechanism used to determine if your benefits are taxable is based on a metric known as combined income. Combined income is calculated by taking your adjusted gross income, adding any non-taxable interest you earned, and then adding exactly half of your total Social Security benefits for the year. If that total number crosses specific income thresholds set by the government, a portion of your benefit becomes subject to ordinary income tax. When this law was expanded again in 1993, it created a two-tiered system where either up to 50% or up to 85% of your benefits could be taxed, depending on your total income bracket. Here is the biggest twist that catches modern retirees off guard. Those income thresholds were established decades ago and were never adjusted for inflation. When the thresholds were first set in 1983, only about 10% of high-earning retirees paid any tax on their benefits. However, because wages and inflation have steadily risen over the decades, while the tax threshold stayed frozen, more than half of all retired households today end up paying federal income tax on their benefits. What started as a tax targeting only the top earners now affects the majority of middle-class seniors who simply have a modest pension or retirement account withdrawal. While this system can certainly feel unfair, understanding the rules allows you to plan ahead. By managing how and when you draw from other financial sources, like traditional retirement accounts, tax-free accounts, or individual investments, you can potentially control your overall combined income and minimize the impact on your monthly benefit. Thank you for watching, and hopefully this sheds some light on the history and mechanics behind why Social Security is taxed today. Thank you.